Welcome, guys, to episode 9. It's Lauren and Ryan here. And this week we are chatting about debt. So I'm really excited because this is something that's kind of been close to me, and I've definitely made some bad choices in my time. So we're just going to be talking about debt, like good debt, bad debt, kind of, how to handle it. So take it away.
Yeah, so welcome, guys. Welcome to the Debt Solutions episode where we talk about too much and how much is too much, how much is not enough, what's good, what's bad. So what we're going to talk about today is essentially the good versus bad debt, which is one of the big common misconceptions. How that looks like, how much debt you can afford, which is another misconception. A lot of people think they can afford far more debt than they can. And how to spin debt from a negative to a positive. So we'll go over all the types of debt, we'll sort of cover off. It's not going to be a super long session today. We say that every time, but we'll see how we go. We're going to cover off more in particular around the mortgages. That's the biggest space. That's the biggest problem or the biggest issue. But we will cover off on the other stuff as well. So let's get into it.
Yeah, cool. I think personally for me, I'm not someone who's worry about it later type person. And when you kind of have, I don't know, let's say it's like a interest-free laptop or something, I'm like, oh, it's only this much per week, pay it off over 3 years, it's literally nothing, and I think even when people maybe are in it a little bit over their heads, when they're breaking it down, they're like, oh, it's only an extra this, and they're like, well, I can fit it in my budget, maybe not budgeting properly, not understanding that they're tipping themselves over the edge. So many people I know have so much personal debt that they're stuck in because they just added on one more thing. It's fine,
So that's all right. You can afford 100 a week, but you can't afford 1,000 a week, which is 10 100s a week, so
yeah,
that's where the issue starts.
Yeah, absolutely. Cool. So what what is too much debt too soon? What's good, bad debt? Do you want to explain a bit more about that?
Yeah, so we'll talk about the problem. So the problem is that people take on too much debt too soon. You nailed on the head there, Loz. What we talk about is people go, it's $100 a week or it's this and that. Now, personal debt wouldn't be a problem if everyone had all of their other stuff sorted first. So from the rest of the series, if they had their retirement sorted, if they had their mortgage sorted, everything, then that's when it's only $100 a week. If I can afford it, I can afford it, because it should be coming from the leftover money, and that's okay. The problem is everyone spends that 100 a week before they've done everything else, and it's money that technically should be or already is spent on something else. That's the issue. We go 100 a week, but that 100 a week really should have been allocated to something far greater, far more important. Whereas we flipped on head, if you do everything else first, personal debt then isn't as bad, isn't as scary, because it's part of your leftover money. Personal debt and that kind of stuff should really come from that luxury or that leftover money. But people are spending money that isn't in that category on personal debt. And the problem is, when we get out of school, we want a car, we want to do this, the whole buy now, pay later mentality, Afterpay, all that stuff. It's a killer, because the problem is, on paper, it's not that bad. It actually makes a little bit of sense in a lot of areas, but the reality is so far torn from that theoretical side that it messes us up. Because in theory, sure, $100 a week, this, that, we talk about credit cards. I'm an avid credit card user for me and my family and for my clients who are at that stage. But the reality, on paper, credit cards, interest-free for a certain period of time, you get bonus points, you get frequent flyers, all that stuff. It sounds really great. And it is. But the reality is, what happens when in the real life version is we miss that interest-free period and we pay a hefty fine. And that's what people miss. People try and focus on the theory side without actually taking into reality what's actually going to happen in their own circumstance. So if you're shit with money, you're going to fall into that interest period and you're going to pay it. So be real with yourself and don't get it in the first place. Whereas when we set up our cash flows for our clients and we get everything now, like me, I make about $3,500 a year off my credit card. Right? That's our household. But we are so, obviously, so in tune with our cash flow and our fund. We pay, at the very last day, we pay our credit card, boom, we're all over it. We pay everything on the credit card, but it's cleared. The interest component's cleared every time, and that's cool and that's all well and good. But that could be easy for me to turn around to everyone and say, hey, I make this much money off my credit card. Everyone should have a credit card, because in theory, it sounds great. But you've got to take the reality into practical use here. And the reality is that most people are going to stuff it up, and it's going to cost them a lot more than they're going to get built up a snowball of debt, So the big thing with debt is be real. Be real with yourself and actually sit down and look at, if you're shit with your money, stay away from it, because that's where debt is the issue. Debt is a compound. We talk about compounded effects in investments and stuff. The compound of interest. It happens the other way too. If you have debt, the interest on that debt, you can pay interest on interest in a bad way, not just a good way. So you got to be really cautious of that, and you've really got to consider first and foremost whether there's a better thing. Like we say in all the episodes, if there's something better, you should be spending that money on first. Okay. And if you've done everything else and you've set up your retirement and you're paying for your home loan, you do all that stuff, and there's money left over and you've got the holiday sorted and the family's sweet, the education's done, that $100 a week, if that's what it is, and you've got that left there, cool, that's fine. But you've got to do those other steps first. People are jumping into debt before doing any steps at all, and that's where the issue becomes.
I think too, like, the problem is that people get very caught up emotionally in what they're getting. So, like, for example, you go into a furniture store and there's a brand new couch and it's beautiful and you sit on it, and then they've got the interest free for whatever months, and you're like, oh my God, I could walk away with this couch and have this new thing. And I do it too. I'm so bad for it. I get so into it. I'm like, oh my God, I could get a new rug and like everything. But like you're not connected with like the outcome and the reality of it, like you said. And I think, me personally, I'm very optimistic. So I was like, oh yeah, like I'll just pay it off early and like it'll be right. And like I'm always focusing on the fact that it's going to work out good. But if you're not across your money, if you haven't got that other stuff sorted, if you haven't done your goal setting and like what's the bigger plan for you and your money, like you can get caught in these traps. And it is.
And the biggest one, Loz, is in, and we've talked about this before, is like, let's say somebody earns $1,000 a week and they spend 900 of it, and they go, I've got $100 a week left over, and they go, oh, this finance is $100 a week. I can afford that. There's no buffer in it. Like that's like there's no buffer. What if you lose your job or if something happens? That money, that if you're going to do personal debt, the only way it makes sense if it is coming from that luxury account. The money that it doesn't have any effect on anything other than your personal joy, right? That's the only way it makes sense. And even then, there's probably a better way. But people are just spending the only money they have. I see people buying shit with money that should be allocated to that annual rego, and then the annual rego comes around and they go, oh my God, I got rego coming up. It happens every year, But you went and spent that $100 a week on the car, no problem. Like, just it blows my mind. You've really got to sit down and if you've done the cash flow section, you're up to here. This shouldn't be an issue, because cash flow is the biggest issue with debt. Debt chews on cash flow. It eats it like a bloody vampire. And if you've got your cash flow all set up, you should know what you can and can't afford. Okay. But that takes us into sort of the next part. We talk about the other problem is the misconception between good and bad debt. Now, people think assets are good debt, but that's not technically the case either. Good debt versus bad debt is described or defined as what is a deductible versus non-deductible debt. So if you can't pay it with pre-tax dollars, technically it's a bad debt. We'd rather pay cash for it, right? Because, and this is where a home loan is technically bad debt because it's non-deductible. So if you live in the house, I've got a bit of a figure there. You've got to be cautious that, for example, why we call it bad debt. If I was to buy a home and it was a $700,000 home, it's going to cost me maybe $1 million in repayments minimum, like plus interest, right? So $300,000 in interest. But people don't take into account you actually have to earn close to $1.3 million to pay that $1 million. So that $700,000 house just cost you $1.3 million. Right? And this is what we've got to consider, because you've got to earn the money, pay the tax, and then pay the loan. Same as a car loan. Most car loans is not through the business. You have to, $100 a week is probably really more like $130 a week. So this is what we're going to look at, because people, tax effective wise, there's better ways to do stuff, and good versus bad debt. It's not just the debt that's the problem, it's the type of debt, because people just think a car loan or a personal loan is bad debt, but we're talking about mortgages as well. If you don't actually structure your mortgage correctly, like you bought a $700,000 home for $1.3 million is what you had to earn to pay that over that time. So that means when your house doubles, it doubles every 10 years. When it doubles, you haven't made any money really yet. You're still breaking even because it's worth what you've actually earned to pay it off over that time. And this is where we get into the issue about non-deductible debt for the home. But I think it's more so the buy now, pay later mentality is what kills it. People just think that, you know, if I get this loan, I can have it now. But what changed me with debt, with my mentality, was actually realizing that figure out how much of it you own. Because if you borrow it, you don't actually own it. The company that is lending you the money, they own it up until the point that when you sell it, you know, if you got into trouble, that you get more money than they do, essentially, right? That's really how that works. So, and it's very hard to do with a car because it's a depreciating asset. But that's when, you know, you don't own your home until you own more of it than the bank does. Think about it like a business. You know, you say how much of that house or how much of that asset that you own, you're a shareholder in that asset. Until you own more of it than the bank does, you don't own it. So we've got to remove that egotistical trade out that we think if I get the loan and get it, I can say I own this shit. You don't own shit. The bank owns it. You're just borrowing it from them for a little while, right? You got to change that mentality and that mindset around it and realize that you actually don't own it. You've got it on loan for a period of time, you know. But really structuring that cash flow around it can help that, because that's what will tell you what you can and can't afford. I think when we talk about like, younger people are a classic example of, you know, like we get out of uni or out of school and we want everything now. And what I wish I was shown is the effect of debt, the compounding effect of debt, you know, and around personal loans is crazy. When you get out of school, you think you need it all now. Now, sometimes you might need it for a car or whatever, but, you know, being modest is a really good one, because let's say you get a $30,000 loan, which is average loan that usually you'll see people walk away with. That $30,000 loan may cost you $40,000 in interest. If we take into account the tax component, probably looking at another 10 grand that you've got to earn. So you probably have to earn 50 grand to pay for that $30,000 loan, right? So that $30,000 car costs you 50 grand. What people don't actually factor in though is, let's say that 50 grand you earn, if we could have reallocated that to investments or whatever, and let's say it's a 7-year loan term, an asset you could have bought at the start of that loan term in that 7 years has probably gone close to doubling. So, you know, because the classic one is get a car and then the next thing you buy is people trying to save up for a house. So let's say it's a house, that $50,000 that you could have used for a deposit or whatever, well, it's now equated to you're going to need 100 grand for the same thing. So that $30,000 car that you've gone and got a loan for has actually cost you $100,000. It's a friggin' expensive car, right? Yeah. That's the thing people don't factor in, is the opportunity cost and the, you know, where else that money could have been spent. So when you look at debt, this is what you need to take into consideration. You need to take into consideration where else, like we said in the cash flow series, where else could I spend this money? And is this the best place for it to go right now? Yeah.
Love it. Cool. So we've gone over who and when. Was that when?
No, that was who. So when, because I think the other problem is, you know, who needs to be cautious about the debt is, so when you have personal loans, especially when you're coming towards the end of a personal loan, make sure you don't start looking at new personal loans. So many people just spend their whole life refinancing car loans. It's ridiculous. Mortgages is the biggest one. Mortgages are the biggest misconception of wealth out there. You know, you take on this big mortgage and, like I said, you think, you know, I've got family members that they have bought a house, and the house is, you know, say they bought it for 300 grand and now it's worth $1 million, and they, I'm rich, you know, it's gone up by this much, but they don't factor in that they actually paid 600 back in repayments, that they had to earn 800 grand to pay that 600, and the fact that everything else gone up around it. So the relative growth on that debt, what they took out all that money for, wasn't very great, you know. So mortgages are huge, and investors, you know, investors got to be very cautious with taking in debt. What happens when we borrow, so gearing we call it, which is borrowing to invest, is you're increasing your risk, which can in turn increase the reward, but can also mean biggest losses. Because I'll give an example here for us to move on with, is if you buy $1 million house, and let's just call it an investment, doesn't matter if it's investment or not, but if you buy $1 million house or $1 million investment and you put down a 10% deposit, right? How much of that do you own, Loz? 10% of $1 million.
100,000.
100,000. I love putting you on the spot. You love it. So 100 grand, right? So you own 100 grand of that house. People sit here and think, oh, I own 100 grand. Now, if that property goes up by 10%, right? So it increases by $100,000. You've made 100% return. You've technically doubled your money. All right. So if that property grows by 10%, you make 100 grand, which means you've doubled your money. You made 100% return. Now that's the I guess the enticing part of borrowing to invest, because you can make a lot more money, a lot less. But this is what we talked about in our risk management session. People don't think about the downside. If that property loses 10%, drops 100 grand, you lose 100% of your investment, right? Because you only have 100 grand in that investment. That's the risk versus reward trade-off with borrowing to invest. So this is what people need to understand. People just see the good side and think, well, but it is super risky, because technically you just lost all your money, right? You lost all your money. And we see it in Western Australia, in Rockhampton, in rural towns, where people jump on these mining booms and stuff like this, and they're sitting on houses now that are worth less than what they borrowed for, and they can't even give the place away, and you got to be really cautious. It's not just in property. It's just a lot easier. You can borrow a lot more against property versus shares. But any borrowing to invest, you've got to be very cautious, because the upside is great, but the downside is also very, very disastrous. And you got to be sure of that. So you got to understand about that as well for investors, to make sure they understand that side of debt. The difference is a loss in investments world, and is all pre-tax. So it's all your costings around it, apart from the principal payments, but most of the costs are all pre-tax. So you can stretch your money a lot further with investments on debt. Before you get into debt, especially about those little ones you talked about, Loz, so credit card purchases that you might be able to afford, personal loans. Depending on the size of the debt, depends on how many days you should sit on it before you make a decision, right? So I like to sit on, if it's something small like a credit card purchase, just sit on it for a day. Sit on it for a day to really figure out whether you need it or not. And if after that 24-hour period you still need it, then buy it. So clothes, all that stuff. So under $1,000, sit on it for a day. Over $1,000, between $1,000 and $10,000, sit on it for a week. And if it's above $10,000, I'd be considering sitting on it for a bit longer than a week. About your car purchases and stuff, you sit on it for a month, essentially. You've got to sit back and really, really assess where you're spending this money, whether there could be better things to do with it, because so many people lose years of their life to debt. And I'm yet to really come across someone with their head screwed on that went, yeah, I'm really glad I got that $30,000 car loan. Like I'm yet to find anyone to do it, and it takes a bit of hindsight and a bit of years to think about it. But, that's what you got to think. The other risk is during debt. When we're in debt, we feel like everything's lost, and we can be very, very easily conned into more debt. You think more debt's going to get you out. It might be you're in a personal debt and you just don't see yourself out. So you try and take another loan out to start a business or to invest, and then you end up even worse off. Or, you got to be really cautious. During being in debt is a really risky time of getting into further debt. You should be focusing when you're in debt. You should not be focusing on getting more debt. You should be focusing on how can I get this debt under control as fast as possible. That should be your focus first and foremost. And then when you finish debt, it's also quite risky, because you finish debt, you got the big sigh of relief. You want to go buy something, it's very easy to fall back into debt really quickly, thinking that you're all over it. So there's three times you're really going to be cautious. The reality is debt's all around us. The world runs on debt, and money's really cheap at the moment. Money is really, really cheap. So it's very easy to get in. The only thing that's going to save you is sitting down and actually analysing whether there's something better your money could be spent on, rather than that debt at that time.
Yeah, I like that one about sitting on it for a little bit. I'm a pretty good example of that. Like, when we were looking at getting my new car, initially, like, I was so excited, and like I was like, yes, like, get the car I want. And Ryan was like, hang on, like, that's crazy. I'm pretty sure he said, if you get a brand new Mercedes, I will not work with you as a client anymore. I was like, okay. He's like, that is dumb. So it was nice having someone to kind of bring me back down a little bit, because I was definitely, like I spoke about, very emotionally excited and like in with the idea. But we sat on it, didn't we? We like thought about, was this the right car? Like, what's the best car that I'd need? What does the job? What's the dream? What kind of like meeting in the middle, in a sense. And I think we ended up spending
we covered it off on the weddings. It's the same any purchase principle that's not money related, so it's not going to make you money. And it's hard with cars. It's like, the car will make you money. Yeah, 4 wheels, 2 wheels on a push bike will make you money. If that's your argument. But when we're talking about cars, weddings, couches, furniture, all that stuff, you need to really sit down and go, okay, what's the non-negotiable? What's the purpose of this thing? So, Loz, with your car, what's the purpose of the car? To get from A to B. Okay, any car can do that. All right. So what do I need as a non-negotiable? What are the things I'm willing to pay for? And you break it down, and we did that. We break it down. Then you go, okay, what is the lowest end I can get that'll achieve those things? And what's the highest range I can afford? And then you want to try and get it somewhere, find that balance between, and whether it's a couch, whether it's your wedding, whether it's a car, whatever it is, especially if you're going to go into debt, you want to keep it down as low as possible. And any expense, even when you pay cash, you want to find out, what is the lowest cost I can pay to achieve exactly what I want to achieve? Rather than just walk into a dealership and say, give me the top range, and then you never use that sunroof ever, and you never notice those leather seats, and you never do that. You know what I mean? Like, you just paid 30 grand in depreciation for absolutely no reason. Same with the couch, or the leg extenders or the cup holders or whatever, whatever it is, that that 1.4% extra comfort, that color difference by like smidge, like, are they really worth that extra money, and do they bring you that happiness and value? And if they don't spend it. And when you're going to debt, that's even more so. You really need to. You don't want to be in debt. You want to be out of debt as long as possible. At least bad debt. Good debt we can utilize, but you need to be on the right plane with everything else before you can utilize good debt. So why is it important that we do all that? I think, I covered off on before. We've only got a certain amount of time and money in this life, right? And for an example, a typical personal loan, 30 grand over 7 years, that's the most common. 7 years, like 7 years, that's almost a decade that you're tying up. And most people with a loan, all their money they've got left over goes towards a loan, and you look and you go, 30 grand, 7 years, you end up paying 50, or you end up paying 40, but you have to earn 50 to pay the 40. And in that 7 years, that asset that you could have bought and caught the bus instead has doubled. So it's actually cost you 100. And now not only that, it's cost you 100 grand. Now you have to save up another 100 grand to get back into that asset. And now we create this vicious cycle. It's going to take you another 10 years to save that 100 grand. So in 10 years, that assets might double again. So now you need 200 grand. Now we're saving another 100. And it creates this cycle. And this is why people never get into a house, while they never get ahead, because they start off on the wrong foot. So you really need to, it's not about the $100 a week. It's about the bigger picture effect of the debt. Okay. It's not here's where we get into a bit of contention. It's not about the 30-year mortgage that you can afford at $4,000 a month, right? What does that mortgage provide? It provides you with a roof over your head, because 95% of you aren't going to use the property as an investment vehicle or to use equity. It's not going to produce you any income. All it's going to produce you is a roof over your head. You want to sell it and you made 800 grand. Guess what? The house next door is also doubled in price now. So you can just buy the same thing back again. You haven't made any money. Or you can move somewhere else and downgrade. Well, you could have done that 20 years ago as well, and you could have been better off as well. So it's all irrelevant, right? That's just a roof over your head. So you're going to spend 30 years paying for this roof over your head, thinking that's the pinnacle of success. Most people get a mortgage from 30. So add 30 years, that's 60. When do you start planning for your retirement? When do you enjoy your life? You've just spent your cream of your years paying off a mortgage. I guarantee you're going to start resenting that roof over your head within 15, right? So it doesn't matter what the debt is. The idea about it is if the debt doesn't return you money, and owner-occupied houses, a roof over your head is one of those. Don't kid yourself. The only way it isn't is if you're a tradie and you go in and you renovate and you flip the place. Great idea. But if you're just moving into a house, paying off it and living, and even if you renovate it just to live in, it is a depreciating asset. Okay, it is barely in line with what you're paying. You're just going to commit yourself to 30 years of only being able to afford a mortgage and not live your life and not plan for anything else. Okay, so and you've got to go and pay tax to pay that debt off. So we've really got to consider, when we're talking about all debts, including a mortgage, what we can afford. Can that money be spent better elsewhere for a longer term picture? Stop thinking in this year and this short-term stuff. Think of it big picture. Which takes us on to how.
Cool. So my mind's just blown. I know we spoke about this before, like owner occupied, and kind of like the fact that it's just when you hear it so simply just put like that, you're like, well, I think we're just we grow up, we're conditioned to think that that's like success, is buying a house and like paying it off.
It's an ego thing, man. It's an ego thing.
Yeah.
Like, and our parents go, don't be materialistic, yet they tell us to buy a house and spend 30 years on a mortgage. What do you think that is? That's pure material. Like a roof over your head is a roof over your head. That's all it is. People look down on people who rent. It provides the same thing, except you don't have rates, you don't have insurances, and you don't have to earn millions more to pay it, and you can free up cash to invest in other things. People can remember that by the time you retire, you need a roof over your head and money to live on, but we spend so much time on number one. You know, we free up so much money on number one, or we do tie up so much money on number one, we forget to number two, and then we've got to resell that house anyway to fund for our retirement. So debt, and this is the problem with debt. And half the reason that housing prices have increased by so much, what people don't understand, is because it's so much easier to borrow money. If we have access to more money, people can sell their houses for a little bit more. And then that compounds. You look at the income to house ratio from 50 years ago to now, that's half the reason that housing prices have increased by so much is not on any fundamental reason other than ego. People know that people are willing to pay a bit more because houses are the pinnacle, so they charge a bit more for it. It's not a real asset. It's a fake egotistical asset. It's not like a business that generates you money. It's just for you to say, I have a nice house. And that's the problem with the housing industry.
Using that property to do more.
That's right, which 95% of people don't, and which is what we'll get onto later in the series. But and half of this idea is to actually tweak your mind to think, change yourself from thinking if you are living in a house with a roof over your head and you're just paying that debt off, it is not an asset until you turn it into an asset.
Yeah.
Okay, until you turn that into an asset, which we'll talk about here. So what is debt, Loz? What is debt? It's very simple. Debt is borrowing money from somebody. It can be the bank, it can be private, it can be whatever. Borrowing money to pay it back over an agreed amount of time with a premium or an interest rate, right? So the person who lends you the money makes the money. That's what debt is, okay? Debt's used all over the world. You know, banks use the debt, people use debt, governments use debt. The global economy runs on debt, unfortunately. It's what makes the world go around, this buy now, pay later mentality, you know. Debt, when it was introduced, was a genius idea, you know. It was brilliant. It's been around forever, and it makes a lot of sense. The problem is people's realistic actions don't warrant what debt should be about, you know. We should, you know, some of the richest people in the world, where they got to where today is purely because of debt. So this is a big issue I have with Barefoot Investor. We talk about, you know, I love the book, but this is one of the common misconceptions. He's very debt adverse. But the problem is, in today's day and age, with the level of incomes we earn and the housing price, it is very hard to get ahead without utilizing debt. But people need to learn to utilize smart debt, you know. Stop the credit cards, stop the afterpay, stop the interest-free periods, stop the personal loans, and start focusing on the good debt that they can provide. You know, I see a lot of people with $1,000 a month debt bills they're paying back, and that's not including a mortgage. That's just debt. You know, you compound that over 10 years, and that's $300,000 worth of money gone to some silly $30,000 loan. So we need to factor this change of mentality around, you know, debt isn't bad. It's just the way we use debt is bad. But it can be one of the big success stories to get you from where you are to where you want to be. You've just got to do it properly and set up your fundamentals and your foundations behind. So that's what debt is. So what is good versus bad debt? Let's go into that a little bit deeper. So deductible versus non-deductible. Okay. So deductible debt is good debt, means that you can claim tax deductions on it. Okay. The downside to deductible debt is you have to pay tax on the gains on the other side. Okay. But that's far less of an issue than people think if you structure it the right way and do. The positive with non-deductible debt, so debt that you have to pay tax on the money to pay, so a mortgage or a car loan. The problem is that when you sell the house, it's tax-free because you've been paying tax the whole way through those monies. Big thing people love, but people forget that they pay tax on the money they use to pay for that place. That's why it's tax free. So they steer away from investments because you have to pay tax on gains, but they forget that you don't pay tax on the money, a lot of the money you spend for it. So it's realistic, it's relative across the board. So we want to steer away. We want to start when we pay back debt, we want to start with deductible, non-deductible, high interest first. Okay, so any debt that you can't claim, you can't pay with pre-tax money and has the highest interest rate, and we snowball effect it. So you want to pump that one. Pick which one the top debt is that's the highest interest rate that you can't claim a tax deduction on, or that you can't pay pre-tax dollars, and you smash that one out, and then go down the list, lowest interest rate, and then on to tax deduct. So deductible debt, highest interest rate to lowest. That's how you should be paying down your debt. Okay. Personal loans, car loans, leases, credit cards, mortgages, investments, own opt, and we've got margin loans, which is borrowing money to invest in shares. These are all types of debt. The only ones on those that are good debt are the ones that you can pay with pre-tax dollars and earn you money, right? So there's two types of deductible debts. There's good deductible debt, bad deductible debt. Good deductible debt is debt that you can pay with pre-tax dollars and it earns you money. So investment loans, shares, property, businesses, etc. Bad deductible debt is like cars and stuff. So stuff that you can, business cars or leases that you can pay with pre-tax dollars, but they depreciate and lose you money. Okay, they're technically still better than the good non-deductible debt. All right, so that's what we got there. Now let's talk about what you can afford. This is the biggest issue. What can you afford? With personal loans, etc., what you can afford is, like I said before, you need to assess whether there's something better you could be spending that money on. Okay, you can afford personal loans, credit cards, etc., within the amount of your luxury account that you set up in the cash flow series. That's it. If it's outside of that, you shouldn't really be able to afford it. If you're someone who needs a car for work, for example, or for the family, and you don't have any other option, you need to do what we talked about before with you, Loz. You need to find what's the cheapest, best solution at the lowest cost that you can get. If you need to get a loan for it, and make sure there's a redraw facility on the loan, and put as much money onto that as you can, and get rid of it as fast as possible. And in an emergency, if you need that money, you can redraw off the redraw. But that is the only circumstance that makes sense. Borrowing for weddings, all that stuff, it never makes sense. Never makes sense. Paying interest on credit cards. If you're paying interest on credit cards or on interest-free stuff, you shouldn't do it. You should get rid of them as soon as possible and sort your cash flow out before you even reconsider going back towards them. Leases on cars, that's a different kettle of fish altogether. That's sort of a business decision, and you really need to see someone specifically about that. It comes down to your position in general, what the purpose of the car is. If you're someone who's going to flip your car every couple of years, if you are going to flip your car every couple of years, the leases make sense from a business point of view. But if you're someone who's going to buy it and hold it for 10 years and look after it, then it doesn't. Cash or a personal loan makes sense. Cash always makes the most sense. But you need to assess that kind of stuff there. Getting onto a mortgage. So mortgage in the way of what you can afford to buy to put a roof over your head. Do you remember what we talk about, Loz? What you can afford? How many years?
Yeah. You want to be able to pay it off in half the time. Is that right? 15
years. Yes.
Yeah.
15 years. So that allows, given that most people, it's not just, and what people get confused with, they go, why would I take a loan out over 15 years? Well, it doesn't mean that. It means you need to look at what you can afford over 15 years, and we still take it out over 30. What that means is a difference in your repayment amounts. You can front load onto the mortgage, which means you're going to be able to pay it off really, really fast, because the first 10 years of a mortgage is where it's all heavily loaded. You're paying more interest on a bigger sum. So if you have more money to front load and get rid of, the back end trail of that debt is so much less, because you're paying less interest on less interest, right? It's not interest on interest anymore. You're paying less interest on less interest.
If you put more money in early, you're reducing. So if let's say you put in $1,000 extra a month early on in your loan, that's going to show up way more than $1,000 a month later on, isn't it? It's going to reduce, right. You're going to pay the loan off quicker, in turn saving a lot more money.
That's right, because you got to remember that the mortgages are calculated, the interest is calculated, I think it's daily or whatever. So the longer you have a bigger balance on that mortgage, the more interest you're going to pay. So if you front load and pay down that balance quicker, your long-term interest is going to be significantly shorter. So if you take a 30-year loan and you say, well, I pay out over 15 years, but we pay it off over 30, it means you've got more cash flow to front load it, or you've got more cash flow to then try and fund your retirement at the same time. But if you take out a loan that you can only afford over 30 years, you're going to be shit out of luck without some really technical strategies. And if you have a mortgage you can only afford over 30 years and you don't have a financial advisor, you're mad. You are not retiring. Like, you're going to be up shit creek without a paddle. So you need to, the reason we say 15 years is because the pressure is so much less. Now, that doesn't mean you can't go and get something you can for 30 years, right? Like, you can. It's just not advised for the general populace, you know? If you're a big aspirational person and we know there's going to be income gains and we've got portfolios set up here and there and everywhere, then you can. The other one is if you're very happy to work to your 65 and your only goal in life is to have a nice house, tick your superannuation numbers, make sure that they're on track to retire you at 65, and then everything else that's left you can pump into your dream home. And then that's what all you have to do is pay off your mortgage and fund your superannuation and your life's done, right? The problem is people don't do that. People just buy the house because our parents told us that that was the thing to do. But the problem people forget is our parents had mortgage rates of 17, 18%. You couldn't return that in any investment. So it made a lot of sense to do that. It's not the case these days. And it's not the case these days. We got money's the lowest ever, so we can do that and do other stuff at the same time. You just need to make sure you have the cash flow to front it. And that's the other problem, Loz, is with interest rates so low, people are stretching 30-year loans on what they can just afford at all-time lowest interest. I see people with loans at 2.3% that they can't afford. What do they think is going to happen? Like, you know, on $1 million, 1%, that's an extra 10 grand a year. Like, people just don't think, like, you can't afford what you got now, where you can pull 10 grand a year from. So these are things we've got to think about, right? And so 15 years on a mortgage debt. Now, if you're going to borrow to invest, depending on the asset, you know, most likely property or shares, I never like to go over more than 50%, right? 50% for shares and 70% for property, okay? Now, that's going to be very contentious because a lot of people you take a lot of risk, but from a risk perspective, that's what we want to be aiming towards doing. And this is where, you know, it makes a lot of sense to change up your strategies and utilize your home equity and stuff like that. But you want to be very cautious because if you don't own enough of that asset, if things go bad, you're going to lose everything. Okay, so home loan, mortgage, 15 years, what you can afford, right? If you want to go above that, you should go and see someone and make sure your strategy is, unless you're happy to work to 65 and that's all you're going to do, and that's fine. For shares, borrow to invest in shares, no more than 50%. So make sure, you know, you have 50% of a deposit and how many. So if you've got 10 grand, you can borrow 10 grand to invest in shares. So you can put 20 grand in the portfolio maximum. That depends on you and your risk profile, but I would never go more than that for the general populace. And then for property, I like to try and go to 70, like make sure you've got a 30% deposit down. However, there is other options around the 5 and 10% that can make sense, but you've got to be really, really cautious about that.
Cool. This is all making heaps of sense. So how do they turn debt into a positive?
All right, so how do we turn debt into a positive? So there's a couple of ways. First, most common way is get your shit together and pay it off as fast as possible. And when you do that, you've then built the habits for investing because now you've figured out a way to pay the debt. What people go wrong is they spend all these years paying debt off. The debt goes and they get another debt, or they just blow that money on something else. The biggest positive, if you got yourself into debt and you learn how to pay it off, you now know you have an allocated amount of monies that you should be able to turn into positive outcomes.
Yeah.
Okay. It's exact same example with, you know, when a husband and wife, the wife goes on maternity leave and you're living on the husband, or she takes 12 months, 3 years off and you're struggling, surviving on one income. It blows my mind when the partner goes back to work and they're still in the same position. Makes no sense. Like you've got a whole nother income now. Right? This is the positive mindset we need to take out of these bad situations. So that's the first one. You know, utilize that allocation for something positive because you know you can do it. You know it's possible. You've done it. So now we need to figure that out. The other way is if you have savings alongside a bad debt, you shouldn't have savings anymore. Okay. There's no point saving and paying off debt at the same time. People say, oh, I'm not sure. It's a simple mathematical equation. If you're paying 5% interest, but you're getting 1% at the bank account, you're losing 4 cents in every dollar trying to save that money. Makes no sense. Okay? Makes no sense. And in $1,000, that's $40. $10,000, that's $400. $100,000, that's $4,000. Goes on and on. Okay, so if you got savings and debt at the same time, you shouldn't. You should be getting rid of your debt. Then we go into the bigger bad debts, right? So that's all personal loans, etc., etc. Go back to the cash flow series, get that sorted, allocate, cut down on some of the luxuries for now and allocate as much as you can to front load your bad debt off. When we talk about home loans though, okay, and we talk about mortgages, how do we turn that bad debt, it's the best of the bad debt, but how do we turn that bad debt into good debt? The idea, and you have to get financial advice for this, you're really going to struggle doing this yourself, but there is strategies around debt reduction and something we call debt recycling out there, where you can transition your non-deductible debt into deductible debt. Okay. And a lot of people do it, but they do it incorrectly. They utilize property. This is the classic use your equity, buy another property, but you're just increasing your debt and you're not able to recycle it through. So all you're doing is using bad debt to create far more good debt, but in a bad scenario. So when we do it properly, what we can do is we can use your equity, create an investment portfolio, and then essentially what you do is you pay down your debt. And as you pay that debt down, you draw that debt away and invest it, right? So by the end of the period, you have the same level of debt, except you have zero. So if you use your home, you have zero debt on your home and all the debt is in an investment portfolio, which is now deductible. So instead of paying your debt off and then starting an investment portfolio, you've transitioned your non-deductible debt into deductible debt, created a portfolio which you can either then sell down and be debt-free in a far greater time because you're using the tax deductibility and the investment earnings of the portfolio to help pay down the debt faster as well. Or you can maintain that portfolio and then slowly pay that off and you can have the passive income, right? Now, this is very technical strategy stuff. You need to see an advisor about it. But this is the stuff that if you're someone who you're stuck with a 30-year loan, or you are, you're not sure about what you're doing, you're not sure about your retirement or your wealth creation, and you have equity in your home, you should be considering this, because otherwise you're going to end the 30-year mortgage with a roof over your head and nothing else to show for it. So figuring out how to transition, getting a strategy in place to transition, turning bad debt into good debt is the best way possible. And that can either come from paying off the bad debt, borrowing good debt, or it can come from a transition strategy such as that.
Yeah. Whoa. My mind's like, woo, trying to keep up. Okay, so we have a case study for you guys just to help kind of explain what Ryan's been talking about. So do you want to go into that a little bit?
Yeah, so a lot of people just have this. This is actually a friend of mine, and they had a property. They got pressured into buying a property, and all my friends went through this period where they got pressured into buying these properties because that was the pinnacle of success. You got frowned upon if you rented. I didn't give a shit. I kept telling them. And I used to get some of my friends, like most of my friends, don't use me as a financial advisor because they don't like my unconventional ways, right? And because they all own properties and I rent. But my wealth strategy is far more above and beyond. And this is the thing, I've had people come to me and be like, why would I listen to you if you got less money than me? And the reason is because I'm doing better with the money I've got than you are. And it's not about how much money you have or how much assets you have. It's about how on track to your personal plan you are. And Gemma and I are years above and in front of where we should be. And that's super successful as far as I'm concerned, where I have other people and clients who earn far more money than me, but they're so far behind their plan and they're so off track that they're not happy with their life. How can they be more successful than me? And this is where this comes from, right? Is we think we need to buy a house because it's the right thing to do. You need to sit down and do your plan, figure out what your life entails, and then you can fit in. If buying a house fits, and there are Loz, we've talked about this. There are circumstances where buying a house makes sense. I'm not against it. I like it, but you've got to make sure it's what's right for you, not just because you think it's the best bet out there, right? So with these clients, they bought the house, they couldn't afford it. I knew they couldn't afford it. I told them they couldn't. And they bought it anyway. Pretty much every cent, like they had to dodge up the numbers with a mortgage broker. They had to live really tight for a few months just to get the loan, dodged up the numbers. And as soon as they were in there, they were miserable. They hated it. Like they were like, yeah, we've got a house. And that subsided after like 3 months. And then they're like, we can't do anything there. We'd ask them to go places. I can't afford it. Can't afford it. What kind of life is that? Right? Just to have a roof over your head that you can say is 5% yours, because that's what deposit you put down. Okay, cool. Yeah. So I started talking to them about renting, and I said, well, the problem is, guys, they earn relatively good incomes. You pay a lot of tax, and right now the only strategy they had in place the only money they had that they could utilize was their tax amount, because every other part of their money that they spent was used spending on the mortgage or living. So we had to come up with a tax strategy. I said, well, the simplest way is for you guys to rent out your home, have some of that, transition that to a deductible cost. So the interest component is deductible. The person who rents it out will pay the principal component. And then you rent again. They actually got to live for free at their new place. So that was good. But they essentially got to move out, and they freed up all this extra cash that they can invest. Now they're investing on the side as well as enjoying their life. They're so much happier, like so much happier. And even if they weren't living for free, if they were renting, it would be the same scenario, because they're so much further ahead. It's ridiculous, because pretty much the amount of tax they pay at the moment is paying for this property, is sorting the property, and they're pretty much in the same position they were before they left, but now they've got a house, right? And so what that meant is they invested in a lot of their goals. They used the deductibility, and the home loan projected went from 25 years to 15 years. Plus, they'll have a $300,000 investment balance at the end of it. So, and that wasn't even advice. That was really, really simple stuff that they sat down and did. And they cut 10 years off their mortgage, plus adding 300,000 to their portfolio outside of that, on top of that home, and they're having a good time doing it. It's a no-brainer. And it came from them completely removing that egotistical trait of, I need a house.
Yeah, for sure. It's like what you spoke about earlier. I think we think that's what we need to be successful, what we're brought up thinking,
Run your own race.
Yeah, totally. And I think sometimes it's got a low key, make moves. It's not, I think buying a house is a very you put it in, it's like you put it on Instagram, you're like, oh, got a house, and everyone congratulates you, which is amazing. But there are people, killing it, like you and Jem, right? You're making moves, you're doing things on the side. No, you don't own a home, but you're on track, you're ahead for your goals, what you want financially. It's not necessarily about ticking. It's not a one box fits all type scenario.
Yeah, and the reality is that buying a home and getting that debt makes sense there's two real scenarios where it makes sense. One, you're a tradie who's going to flip it. Doesn't matter what market, you can almost always make money if you're a tradie that can flip houses, but you have to be able to flip it inside 5 years. The other one is if you're a family. One of the biggest annoyances and costly exercises is renting as a family and constantly getting uplifted and uprooted out from landlords. And that is an offset decision that you need to weigh up, because it does make sense. But that's where you need to make sure that you are doing it in the best way possible. Because I'll be honest, I'll throw a controversial thing out there that buying a house is one of the biggest reasons a lot of Aussies don't do well financially. They tie all their money up in the roof over their head and they do nothing with it. And that's not me saying don't buy a house. Loz, you can attest to this. One of our biggest goals with every single client of mine is buying a house. It's just about how you do it and when you do it and the way to do it, to make sure that you're not sacrificing the rest of your life just to have a roof over your head.
Yeah, having a strategy, not just doing it because you think it's the right thing and getting caught up. Yeah, I love it. I feel like this session's been really good. So we've got some takeaways and things just to go away and implement and do for you guys. So takeaway number 1.
All right, so you really need to consider if the debt is the best idea or the best use of your money before using it. Think about what else you could do with that money instead and weigh up which decision is right, because 9 times out of 10, you're going to regret getting the debt.
Yeah, love it. Takeaway number 2.
So I'm going to change this one. It was something else, but I'm going to change this to sitting on your debts, right? So sitting on your decisions with your debt. So if it's under $1,000, sit on it for a day. If it's over between $1,000 and $10,000, sit on it for a week. If it's above $10,000, sit on it for a month.
Yeah. Love that. I think you'll most likely talk yourself out of stupid debt if you just sit on it long enough. Number 3.
All right, number 3. So with your big debts, with your mortgages, aim for 15 years. And it doesn't have to be exactly 15 years, just try and stick to what you can afford. So obviously we talk about with cars laws, what's the purpose of the house, what makes you happy, and trying to find that balance between cost and happiness. So with the house, try and get what you're happy for as close to that 15-year mark for repayment as possible than the 30, because the reality is 15 to 20 years is more so what you can afford than 30. If it's 30 years, you can't really afford it.
Yeah, love it. Okay, so 3 things we want you to go away and do. Number 1.
Yeah, so number 1, look at all your debts and assess if you're getting the best rates. So go away and review all of your current interest rates for your debts.
Cool. Number 2.
Number 2, if you have debt and savings, it's time to get rid of those savings and pay down that debt.
Yep. I want to ask you something for this too. So for example, if you just had, let's say you had $30,000 sitting away somewhere, but you also had $30,000 debt, but you had no buffer in your accounts, you just set up your accounts like we spoke about the other day, what would you suggest to that person? Would you say you need the buffer first and before you pay off the debts? Or you're saying leave yourself with essentially nothing spare?
No. So that's why we said with the debt, you need to try and get a redraw. Okay. If you have a mortgage or whatever, if you have a mortgage, your buffer should be your offset account. Okay.
Yeah.
If you've got one of those budget mortgages that the mortgage broker sold you for a cheaper interest rate, so you have no offset, your mortgage broker's a spastic. You need to move on. You need that buffer. The amount of money you will save having that buffer there as an emergency will far outweigh that. So your buffer should be sitting in your offset. For personal loans, you've got to redraw. Now, we do need to understand that redraws aren't guaranteed. The bank can wipe a redraw, and they have been doing it through COVID. But it is more beneficial that you put that $30,000 buffer on the debt, and then you get an emergency credit card or something for $15,000 or $10,000, and you put it away where you can't touch it, but it's there, and you have a backup debt that actually isn't debt. So a credit card's a good idea. That you can utilize for emergency until you build that buffer up, and then you cut that credit card up, because that's a better idea, having a debt facility there that you're not paying any interest on as your emergency, rather than paying interest on your debt to have an emergency buffer there.
Yeah, I like that. So put your savings on your debt, get a credit card as a backup, build your savings or your buffer back up, get rid of the debt.
Because if you pay off your debt, say you've got a $30,000 debt and you've got $15,000 in emergency, if you put 15 grand on it and you start paying that off, worst case scenario, the bank would lend you that 15 grand back again. But there's a high likely chance that you're not going to need to do that. So it's a less percentage play opportunity. So I'd rather you punch that debt away and get rid of it quicker. And if the worst case scenario happened where you needed that money, then you can go and redraw it or borrow, because you might not need the whole 15, you might only need to borrow 5 again. Than actually paying interest on the entire amount because you want to have this buffer there.
Yeah, I like that, because I think there's probably people out there that do have savings but also have debt, and they're afraid of letting go of that savings. Yeah,
all of them. It's an ego thing as well. You think that if I have the savings that I'm doing well, you're doing a disservice to yourself. Cut your ego, cut the shit, get rid of that debt.
Yeah, cool. Number 3.
All right. So I want everyone to go back through their cash flow, set it up and buffer, have a look and see during between now and the end of the year, how much can you cut out of some luxury stuff? If you've got debt, it generally means you've been living above your means, right? So your balance is a bit off because you've been having a little bit more fun than the other side, right? You've done a little bit more than you can afford. So from between now and the end of the year, I want you to really scrounge through your budget and look at things you can cut away, that we can start piling into this debt over the next 3 months to try and front load going into 2021 with a far less time frame on your debt. Yeah.
Love it. So we had a question. Morgan asked how to pay off debt. I feel like it's probably been covered.
Sort of. So I've actually answered Morgan individually on this one before, but I will answer it here. There's no secret, guys. There is no secret. The reality is you just got to get out and do it. one of the things is that we just mentioned, a lot of people will have savings next to their debt and try and do two at the same thing. Use a snowball strategy. Target that debt, put everything you've got into it, and get rid of it. Cut out your luxuries. If you've got debt and you're trying to pay it off, tighten up. You've gone too big at one point, you need to tighten it up. And where you can, try and transition that bad debt into good debt. So if that's personal debt, just suck it up. Get another job. Do what you need to do. Fire down that debt as fast as you can. Use your savings. Get rid of that debt. Make sure it's the lowest interest rate. Whatever you need to do, just get rid of it. Hustle, hustle, hustle. Make sure your cash flow is set up. If you have a good cash flow system, the debt will not be an issue because it might scare some people. Some of those people have got debt when they couldn't afford it. It's probably, they didn't have a cash flow system in the first place, so it's going to be really hard. But that's just going to be a wake-up call. You now need to backset. You need to maybe go rent a cheaper place or sell your car. Do something. Get rid of that debt. Start from square one again. If it is a home that you're talking about, how to pay off debt, well, again, you might have over-leveraged, gone too hard. But if it's a home, you do need to consider how can you front load that debt down as fast as possible to get it to a position to say 70% equity or 70% LVR. So we have 30% equity. Because at about 70%, you can start considering some small time investment options where you can utilize that equity and help you pay down that debt faster. So, but the first and foremost answer is always hustle, get your shit together, get your cash flow sorted and pay it down, front load it as fast as possible. And you can figure out strategies off the back of that.
Yeah. Love it. I feel like I've learned a lot. Hopefully people have taken away some stuff from this and, have learned some stuff that they can go and implement. Next week, we are talking about investment vehicles. So I know there was a lot of questions initially when we put out what we were doing and people wanted to know what's the best investment, things like that. So this is the episode for you. I'm excited.
Yeah, we'll talk about all the different types of places you can invest. So let me just double check. I'm not sure. Yeah, so this isn't about strategies and products. This is about vehicles. So, first step of where are the places you can invest. And then the session after that, we're talking about what you can invest in once you're in those vehicles.
Yeah. Okay. Love it. Well, thanks guys for watching. Hope you enjoyed this week and we'll see you next week. Bye.